Hello, friends. Imagine opening your mailbox, pulling out your property tax bill, and seeing that your county is demanding $5,000. That is a massive sudden increase just because homes in your neighborhood are selling for record prices to buyers who do not even live there. For millions of seniors living on a strict fixed income, rising property taxes are not just an annoyance. They are an existential threat that is literally forcing people out of the homes they spent 30 years paying off. But what the county tax assessor will never openly advertise to you is that there are massive legally mandated senior exemptions designed to drastically lower or even freeze your tax bill. According to the AARP, a staggering 92% of eligible seniors completely miss out on these benefits. Why? Because the government forces you to actively find and apply for them. I want to be perfectly clear right from the start. This is not a federal stimulus check. This is not an automatic tax refund from the IRS. These are specific existing state and county property tax exemptions that you are legally entitled to right now. But you must manually apply for them at your local tax office to lower your bill. No one is going to do it for you. If you stick with me until the end of this video, I am also going to reveal what is known as the Circuit Breaker Refund. This is a quiet state-level tax loophole that actually cuts you a cash check to reimburse you if your property taxes take up too much of your Social Security income. We are going to look at how that works in just a few minutes. Rules change every single year, and the government never sends out a letter explaining your options. The people who subscribe to this channel find out about these changes in time to save their money. The people who do not find out after the money is already gone out of their bank accounts. Take a second to subscribe right now so you do not miss these updates when they matter most. Let us look at why so many people get trapped by what I call the 92% trap. This is the age-based assessed value reduction, commonly known as the Senior Homestead Exemption. Most homeowners already have a standard homestead exemption on their primary residence. It gives you a basic reduction on your home's value before they calculate your tax. But when you turn 65, and in some states when you turn 60 or 61, almost every state offers an additional senior exemption. This law slashes tens of thousands of dollars more off your home's assessed value before the local tax rate is ever applied. Yet those AARP studies show 92% of eligible seniors fail to claim it because the county keeps it quiet and makes it strictly non-automatic. Here is exactly how you fix this. First, find your most recent property tax bill. Look closely at the line labeled Exemptions. If it only says Standard Homestead, you are actively losing money to the county. Next, you need to go to your county tax appraisal district website or walk directly into their physical office. Request the document called the Over 6.5 Exemption Application. Fill it out completely and file it right there, along with a copy of your driver's license to prove your age. Let me show you how this works out in real numbers. Take a look at Robert, a 66-year-old homeowner in Texas. Robert owns a home assessed by the county at $300,000. The local property tax rate in his area is 2%. Because Robert did not know any better, he never applied for the over 65 exemption when he hit the age milestone. Without the senior exemption, Robert pays that 2% rate on the full $300,000. That means his annual tax bill is $6,000 a year. Once Robert discovered this mistake, he went down to the county office and filed the over 6.5 paperwork. That single action legally removed $50,000 from his assessed value. The county is now legally blocked from taxing him on that amount. Now, Robert is only taxed on an assessed value of $250,000. 2% of $250,000 comes out to exactly $5,000, comes out to exactly $5,000 a year. Over 10 years of retirement, filling out that one free piece of paper keeps $10,000 in his bank account instead of giving it to the local government. Keep in mind that this varies depending on where your primary residence is located. New York State uses what is called the Enhanced STAR program. This is specifically for seniors with incomes under roughly $103,350, and it provides a massive direct reduction in school taxes. Florida, on the other hand, offers an additional $50,000 senior exemption, but they restrict it strictly to low-income seniors. But slashing your assessed value is only half the battle. If your local housing market is booming, your taxes will still go up next year unless you lock the door. That brings us to the Senior Valuation Freeze, which legally locks the ceiling on your home. This program is designed for middle to low income seniors living in states that offer assessment freezes, including Texas, Illinois, Georgia, and New Jersey. A Senior Valuation Freeze legally locks your property's assessed value for tax purposes at the exact dollar amount it was on the day you applied. Even if the real estate market goes crazy and your home doubles in market value, the county is legally banned from raising the assessment value they base your taxes on. To secure this protection, your action steps are very specific. First, verify if your state offers a senior freeze, which is sometimes called a senior tax deferral or a senior tax freeze. Next, you must gather your Social Security Form 1099 and your annual pension statements to prove your total income falls below your county's specific limit. Then take those documents and file the senior freeze affidavit at the county assessor's office. You must hit their strict spring deadline, which often falls in March or April. Finally, check your local rules, because some states require you to recertify your income annually to keep the freeze active. Look at what this did for Susan, a 67-year-old living in a booming suburb in Illinois. Her home was assessed at $200,000 when her income qualified for the program. She filed her paperwork and locked it in. Over the next 5 years, heavy gentrification hit her neighborhood, causing her home's real market value to soar to $400,000. Without the freeze, Susan would have been forced to pay taxes on that new $400,000 market value. That would have doubled her property tax bill from $4,000 to $8,000 a year, which would have forced her to sell the home because her fixed income could not handle a $4,000 annual increase. But because Susan locked her freeze in at $200,000, she continues to pay taxes based only on that original value. She avoids that $4,000 annual tax hike entirely. That saves her $20,000 over those 5 years, all while her home's equity grows completely tax sheltered. You need to understand one crucial variation here. A freeze locks the assessed value of the physical structure and land. But if your city votes to raise the local tax percentage rate itself, for instance, raising the rate from 2% to 2.5% to build a new school, your bill will still go up slightly. The program freezes the house value, not the tax rate itself. If you eventually decide the house is simply too big and you want to downsize to something smaller, the federal government steps in with the most powerful real estate exemption in the entire United States tax code. This brings us to the capital gains home sale exclusion, which is found under Section 121 of the IRS tax code. This exemption applies to any senior selling a primary residence that they have owned and lived in for at least 2 out of the last 5 years. Many seniors are completely terrified to sell their homes because of a classic real estate trap. They bought their house for $50,000 back in 1980. It is now worth $450,000. And they fear the IRS is going to take a massive chunk of that $400,000 profit in capital gains taxes. But under Section 121, up to $250,000 of profit for a single person and up to $500,000 of profit for a married couple is 100% legally exempt from federal capital gains taxes. Here is how you handle the steps when you sell. First, calculate your true cost basis. You do this by taking your original purchase price and adding the exact cost of any major structural renovations you paid for over the years, like a new roof or a kitchen addition. Second, subtract that total cost basis from your final sale price to find your exact profit. Third, double-check your calendar to ensure you physically lived in the home for 24 out of the last 60 months before the sale date. Finally, apply the $250,000 single exclusion or the $500,000 married exclusion directly on your federal tax return. Let us look at David and Linda, a married couple who bought their home decades ago for $100,000. Over 30 years, they added a $50,000. Over 30 years, they added a $50,000 kitchen upgrade. That means their adjusted cost basis is $150,000. In 2026, they decide to sell the home to downsize, and they close the sale at $550,000. To find their profit, you take that sale price of $550,000 and subtract their $150,000 basis. That leaves them with $400,000 in pure profit because they are married and filed jointly. Their Section 121 legal exclusion covers up to $500,000. that entire $400,000 profit falls completely under the federal shield. David and Linda owe exactly $0 and 0 cents in federal capital gains taxes on that sale. They walk away with $500,000 in completely untaxed cash. There is a vital situation variation to know if health changes force a move. If a senior has to move directly into a licensed nursing home, the IRS grants a special medical exception to the timeline. Instead of living in the home for 2 years, they only need to have lived in the property for 1 year out of the last 5 years to claim this full tax shield. This shield provides massive security for married couples while they are both living in the home. But a major point of anxiety for many families is what happens to these senior property tax exemptions if one spouse unexpectedly passes away. That is where the surviving spouse tax transfer comes into play. This portability exemption applies specifically to widows or widowers aged 55 and older, whose deceased spouse held an over 6.5 exemption on the home. When an older spouse dies, the surviving younger spouse often panics because they might only be 60 or 61. They assume they will legally lose the senior tax exemption because they are not yet 65, causing their property taxes to explode overnight. But many states have an explicit widow portability law. If the surviving spouse is at least 55 years old, they legally inherit the deceased spouse's over 65 exemption and keep the lower tax brackets intact. When dealing with a loss, you cannot ignore the county tax assessor, or they will automatically reset your rates. First, take the official death certificate down to your local county tax office. Second, request and file the specific form titled the Surviving Spouse Exemption Transfer. Third, verify with the clerk that your name is accurately listed as the sole surviving owner on the property deed, so the county system does not automatically flag and strip the exemption during their annual audit. Let us look at how this saved Mary's finances. Her husband John passed away at age 68. Mary was only 61 years old at the time. While John was alive, their home carried the full over 65 tax freeze, which kept their property tax bill locked at $2,000 a year. Because Mary was over 55, she immediately filed the surviving spouse portability paperwork with the county. The county tax office legally transferred John's over 6.5 exemption directly to Mary, even though she was 4 years away from turning 65 herself. Her annual bill stayed locked at exactly $2,000 a year. If Mary had failed to file that specific form, the county would have automatically removed the freeze at the end of the tax year, resetting the home's value to the current market peak and exploding her bill to $4,500 a year. Mary saves $2,500 every single year purely because she submitted that one-page transfer form. Depending on your state, there can be additional layers of protection here. In Florida, for example, widows and widows receive a flat $5,000 property tax exemption simply for being a surviving spouse, which is granted completely independent of their age. While you are protecting the outside of your property from the county assessor, the federal government is actively offering a massive tax credit to help you fix up the inside of it. This is the Home Improvement Tax Credit, known legally as the Federal 25C Energy Efficiency Credit. This credit applies to senior homeowners who are replacing old windows, exterior doors, or upgrading their home comfort systems to highly efficient electric heat pumps. Under the Inflation Reduction Act, this Section 25C tax credit is fully active right now through the year 2032. If you buy qualifying energy-efficient items for your primary home, you can claim a 30% tax credit up to $1,200 for general improvements like windows and doors, and a massive individual credit of up to $2,000 if you install an electric heat pump. To claim this money, you must follow a precise step-by-step process. First, before you hire a contractor or sign a contract for a new air conditioning unit or furnace, ask the company for written proof answering this question. Does this exact model number qualify for the federal 25C tax credit? Second, once the job is completed, ensure you put the manufacturer certification statement and your final itemized invoice into a safe file. Third, when it is time to file your federal income taxes, fill out IRS Form 5695. Finally, apply that 30% credit directly against your federal income tax liability. Look at the math for Richard, a 72-year-old homeowner who needed to replace his failing central heating and cooling system. He spent $8,000 to purchase and install a highly efficient electric heat pump system. Richard applies the 30% credit to his installation cost. 30% of $8,000 comes out to $2,400. However, because the IRS caps the heat pump credit at exactly $2,000, Richard receives a flat $2,000 dollar for dollar reduction on his federal tax bill. On top of that, his new energy-efficient system lowers his monthly utility costs by $40 a month, which puts another $480 back in his pocket in the first year. Richard's total first-year financial gain comes out to $2,480. You must be aware of a major limitation before you count on this money. This is a strictly non-refundable tax credit. If your Social Security and pension income are low enough that your federal income tax bill is already $0, you cannot use this credit to get a refund check mailed to you. It can only be used to wipe out taxes that you actually owe to the IRS. If your income is low enough that your taxes are already zero, rising property bills become an immediate threat to your home. When things get tight, many seniors get desperate and sign up for a government deferral program, which can turn out to be a massive financial mistake. This brings us directly to the state lien program, which is commonly marketed to older Americans as the property tax deferral. This program is aimed at seniors who absolutely cannot afford their annual property tax bill and are offered a way to postpone those payments by their state or local county. Many seniors sign up for this thinking it is just another form of a senior exemption. It is not. It is a government loan. When you enroll, the state places a silent lien on your house, and they charge you compound annual interest on every single dollar of taxes you delay paying. The moment you pass away or decide to sell the home, the state steps in and takes that accumulated cash directly out of your estate before your family gets a dime. If you're considering this, you must complete these diagnostic steps first. First, if the county offers to defer or postpone your taxes, force the clerk to give you the exact interest rate they will charge you every year. Second, sit down and recognize that you are legally signing away a portion of your home's equity to the government. Third, promise yourself that you will only use this program as an absolute last resort to avoid immediate foreclosure. Fourth, warn your adult children about the agreement so they are not completely blindsided by a massive state lien when they inherit the property. Let us look at how the math compounds against Tom, a 75-year-old homeowner. Tom used a deferral program in Colorado to delay his $3,000 annual property tax bill for 5 consecutive years. The state charged him a 5% annual interest rate on those deferred balances. Over those 5 years, the state technically paid $15,000 in taxes on Tom's behalf, but because of how compound interest works over time, the silent lien against Tom's house grew to roughly $17,000. When Tom passed away, his children tried to sell the house to settle his estate. Before a single penny from the sale could go to his kids, the state stepped in with their lien and legally seized $17,000 out of the closing proceeds to pay off the tax debt. The danger changes depending on where you live. Some states charge a brutal 8% interest rate on deferred property taxes, while other states subsidize the program down to a mild 1%. You should never sign any deferral paperwork without knowing your exact local interest rate. Instead of taking a high-interest loan from the government, what if the state government actually cut you a check to reimburse you for the property taxes you already paid? That is the power of the state property tax circuit breaker credit, which is the secret tax loophole we teased at the beginning of the video. This program applies to seniors on low to moderate fixed incomes who live in one of the roughly 30 states that currently offer circuit breaker programs, such as Michigan, Massachusetts, New York, and Pennsylvania. Just like an electrical circuit breaker trips in your garage when a circuit is overloaded with power, these state tax credits trip when your property tax bill overloads your fixed income. If your property taxes exceed a specific threshold of your total annual income, usually around 5%, the state refunds the excess amount directly back to you, either as a direct cash check or a major credit on your state income tax return. To claim this cash, you must take these exact actions. First, go to a computer and look up your specific state Department of Revenue website to see if they offer a property tax circuit breaker for seniors. Second, realize that even if your income is so low that you owe $0 in state income taxes, You must file a state tax return anyway to claim this money. Third, fill out the specific schedule on that return titled the property tax credit, making sure to list your exact total income and the total property taxes you paid for the year. Fourth, wait for the state to mail your cash refund check directly to your mailbox. Look at how this worked for Linda, a 71-year-old homeowner in Massachusetts. Linda lives on a strict Social Security and pension income of $30,000 a year. Her local property taxes are $3,000 a year. If you look at the math, Linda's property taxes consume exactly 10% of her entire annual income. The Massachusetts circuit breaker limit states that anything over 5% of your income is an overload. 5% of Linda's $30,000 income is $1,500. Because Linda actually paid $3,000, she is exactly $1,500 over the overload limit. Linda filed her state tax return and completed the proper schedule. The state of Massachusetts mailed her a direct cash refund check for $1,500. Linda keeps her house, regains her liquid cash, and never has to take a predatory loan against her home equity. This loophole carries an incredible variation that almost no one talks about. This program is highly powerful for seniors who rent their homes. In many states, the circuit breaker rules explicitly allow seniors who rent apartments to claim a specific portion of their monthly rent as property taxes paid by the landlord. This results in senior renters receiving $500 to $1,000 cash refund checks directly from the state every single year. Let us review everything we covered today so you can protect your wealth. We looked at the over 65 senior Homestead exemption that can slash $50,000 off your assessed value and save you a quick $1,000 a year like Robert. We covered the senior valuation freeze that can lock your home's assessed value in place for years, saving you $20,000 or more if your neighborhood is gentrifying. We broke down the massive Section 121 capital gains exclusion that allows married couples to shield up to $500,000 in pure profit from federal taxes when downsizing. We went over the surviving spouse portability transfer that keeps a widow's tax bill from doubling overnight by transferring an existing freeze. We examined the federal 25C credit, which can give you a flat $2,000 tax reduction for upgrading to an efficient heat pump. We exposed the state tax deferral trap, showing how a silent lien can steal $17,000 from your children through compound interest. And finally, we revealed the state circuit breaker credit that can trip when taxes overload your fixed income, putting a $1,500 refund check directly into your hands. Your home is your greatest asset and your ultimate safety net. By taking the initiative to file for these legal exemptions at the county level, you stop the government from taxing you out of the retirement you worked your whole life to build.